So let's dive straight into this explainer where we put Corning Inc. through the absolute ultimate investment valuation gauntlet. We're looking at a company right now that is caught in the middle of a massive artificial intelligence supercycle. But as expert investment analysts, we really have to ask ourselves, does the underlying math actually justify all this hype? We're going to strip away the noise today and run Corning through the industry's most rigorous financial frameworks to find out exactly what it's worth. Okay, here is our roadmap for today. We'll cover a company snapshot and the Buffett lens, the Peter Lynch lens, the Benjamin Graham lens, a DCF base case valuation, some alternative valuation models, and finally a synthesis and final recommendation. Section 1. Company snapshot and Buffett, the Oracle's perspective. Trading at around $196.12, Corning is this absolute materials science giant that is aggressively pushing into AI fiber and solar tech. They've actually built the largest solar ingot and wafer facility in the US, in Michigan, in just 18 months. Plus, their optical fiber is literally the backbone of the generative AI data center boom. They aren't just participating in these markets, they are completely essential to them. Now, what's fascinating is that Corning easily passes Warren Buffett's qualitative checklist. They boast a massive economic moat. Their cover glass is designed into over 8 billion devices. And they have multi-billion-dollar contracts with hyperscalers like Meta. Add to that 8 consecutive quarters of year-over-year sales growth, a really healthy 13.5% return on invested capital, and totally manageable debt given their cash on hand. If we annualize their Q1 adjusted free cash flow of $188 million, we're looking at roughly $752 million in owner earnings. But here's the catch. Applying a strict multiple on those owner earnings and requiring a 30% margin of safety, Buffett's likely buy trigger sits far below the current price, at around $90. The qualitative business is fantastic, sure, but Buffett would absolutely never pay the current premium for it. Section 2. The Peter Lynch lens. Growth at a reasonable price? Peter Lynch loved categorizing companies as stalwarts and fast growers. But he always demanded a reasonable PEG ratio to ensure he just wasn't overpaying for that growth. For him, a PEG ratio of 1.0 is the absolute gold standard for a fairly valued stock. So while Corning is riding a 30% core EPS growth wave fueled by those hyperscalers, a PEG ratio of 3.12 makes it aggressively overvalued in Lynch's eyes. You divide that sky-high 93.84 PE ratio by their 30% growth rate, and, well, it's a clear fail. Plus, with institutional ownership sitting at nearly 70% and almost $2.5 billion in net inflows over the last year, Wall Street is already heavily crowded into this trade. That is the exact opposite of what Lynch looked for. Honestly, to get that PEG ratio down to Lynch's magic 1.0 threshold, the stock would need a massive pullback, triggering a buy around $62. Right now, Lynch would probably view this as a great business that has simply become way too popular. Section 3. The Benjamin Graham lens, the defensive investor. Graham relies on hard, tangible book value and trailing earnings to calculate a company's absolute intrinsic value. He offers zero credit for future AI promises. His formula, which is the square root of 22.5 times EPS times book value per share, is his ultimate test of a stock's grounding in reality. Extracting the data directly from their Q1 balance sheet, we take their $12.3 billion in total equity and divide it by their 871 million diluted shares. That gives us a book value per share of $14.17. And this is exactly what Graham wants to see. Hard, tangible assets. Corning easily passes Graham's size test and his financial health checks. Its 18-year dividend record is also excellent. But the valuation? It completely shatters Graham's limits. A PE of almost 94 obliterates his limit of 15, and a price-to-book of 13.8 makes a total mockery of his 1.5 maximum. Benjamin Graham would take one look at those multiples and literally run for the hills. Plugging our $2.09 trailing EPS and our calculated $14.17 book value into his formula, Graham's absolute intrinsic value sits at an ultra-conservative $25.80. Graham would demand a very wide margin of safety from this point to even consider a buy for your portfolio. Section 4. DCF base case valuation. Modeling the future. Because the sources lack exact multi-year cash flow projections or boldly setting these base assumptions. We're starting with $752 million in annualized free cash flow. Then we project a 15% growth rate over the next 5 years to account for their surging optical fiber business and the upgraded Springboard plan, which targets $11 billion in incremental sales. Finally, we apply a 2% terminal growth rate and discount it all back at a 9% weighted average cost of capital. Tweaking the discount rate or growth even slightly drastically alters the outcome here. Even if you apply a riskier 8% WACC and an optimistic 2.5% terminal growth, you only stretch the value to $75.30. That is still nowhere near the current share price. Locking in our base case assumptions, the DCF model suggests a fair value of around $55 per share. This is heavily anchored by their current cash flow capabilities compared to their massive $174 billion market capitalization. Section 5. Alternative Valuation Models, DDM and EV to EBITDA. Using the dividend discount model, which rewards Corning's stable dividend that currently yields about 0.57%, and projecting a 4.46% expected dividend increase against an 8% required return, we get a fair value of $33. Meanwhile, using an enterprise value to EV approach, calculating the roughly $181 billion EV and applying an industry-standard multiple gives us a slightly higher $45 benchmark. Basically, neither model validates the $196 price tag for a value-conscious investor. Section 6. Synthesis and final recommendation. When we zoom out and look across every single fundamental framework, a really stark reality emerges. Corning's current market price is massively disconnected from historical valuation models. The market is pricing in the absolute best-case scenario for their generative AI and solar businesses, completely abandoning traditional multipliers. For your portfolio, this means you are paying a massive premium for future promises. While the business is fundamentally stellar, they're executing flawlessly on their Springboard plan, growing Q1 sales 18%, and locking in massive multi-year contracts with Meta and other hyperscalers, the stock is currently priced for absolute perfection. Think about this. A minor Q2 guidance miss of just $50 million recently caused the stock to drop 9%. That is the danger of a 93.84 PE ratio. The fundamentals screams sell, but the sheer momentum of AI infrastructure makes it a cautious hold for current owners who want to ride the trend. So as you weigh the AI supercycle against the mathematical realities, the big question remains: at what margin of safety will you buy? Are you willing to ignore Graham, Lynch, and Buffett to own a piece of the AI backbone today, or are you waiting for the numbers to come back down to earth? Thanks for joining me on this explainer. Keep doing the math, and I'll see you next time.